Hello and welcome to Wall Street Vision. On this show, we explore the thinking of the best investors and we examine lessons from the stock market. I'm your host, Vlad Dolgochev. This show is for informational purposes only and is not investment advice. Check out the show notes for the full disclaimer. Hello, Vision Nation. I hope you guys are having a great week. Did you notice the new cover art for the show? I figured that this version is a little bit better than the old one that I put together using my very limited Photoshop skills. In this week's episode, we're going to discuss luck versus skill in investing. Understanding the difference is really important for investors. Because in investing, you can control your skill, but you can't control your luck. So as investors, it's super important to be able to separate the two and to understand when we achieved success because of luck and when we achieved it because of skill. That is one amazing ingredient in the secret sauce for improving your decision-making skills. I'm going to start off with a story to illustrate this. So it's the Super Bowl a few years back, and the New England Patriots are facing the Seattle Seahawks. This is the chance for the Seattle Seahawks to win their second Super Bowl in a row and to prove that their last year's win wasn't a fluke. It's been a long season for Pete Carroll. He's the Seahawks coach. NFL coaches are notorious for having crazy working hours during the season. It's pretty common to work 12 hours plus per day, 7 days a week. Ouch. And many coaches sleep in their offices to save time on commuting because their schedule is so jam-packed. After months of grinding out that schedule, Pete is exhausted. That schedule is more intense than investment banking. Pete's family is missing him and his body is drained. But he brushes aside his fatigue, and on the surface, he puts on this intense, focused face. It's his chance to keep the momentum for a football dynasty, which is something that he's been dreaming of for a long time. Fast forward to the end of the game, and the Seattle Seahawks are on the verge of beating the Patriots. Pete is super pumped. This is it. Victory is in sight. His team is so close to winning. There's less than a minute left in the game, and Seattle have 3 tries to score a touchdown. They're at the 1-yard line, which means it should be relatively easy to score and win the game. At this point, everyone is expecting the Seattle quarterback to pass the ball to Marshawn Lynch. And Marshawn is an amazing touchdown machine, and he's broken all sorts of records, so this would be the obvious pick. But instead, Pete tells the quarterback to throw the ball to another player. The football gets intercepted by New England, and New England wins the Super Bowl. Pete is absolutely gutted, coming home empty-handed after all that hard work and effort and all those months sleeping in the office. The headlines are ruthless the next day. Here's a few of them so that you can get a sense for the type of heat that the coach was feeling. A coach's terrible Super Bowl mistake. Or what about this one? Dumbest call in Super Bowl history. Alright, so everyone's a genius when looking back at a situation. Why did so many people crap all over the Seattle coach? Well, it was because the play didn't work out. Everyone saw the outcome and immediately they were pointing fingers at the coach saying, that was a bad decision, instead of saying, that was just bad luck. But here's the thing. Some stats people went in to take a closer look, and they figured out that out of the 66 passes attempted from that same position during the season, there were 0 interceptions. And in the previous 15 seasons, only 2% of those plays were intercepted. That means the coach made a statistically good decision, and it just didn't work out for him. The odds were on his side, and he made a good call. If you had a chance to repeat that same play 100 times, he probably would have been successful on most of them. And if the play worked, the headlines would have been raving about what a good call that was and what a great coach he is. Here's the issue. In investing, in sports, and in life, we have this tendency to link up the quality of a decision with the quality of the results. But that's not the way it actually works. You can make a good decision and have a bad result, and you can make a bad decision and have a good result. Making good decisions doesn't guarantee success, but it does give you an advantage as long as you keep making good decisions long term. You see, short-term results are mostly about luck. Medium to long-term, skill plays a bigger factor. That's why they call it beginner's luck. So if you're judging your portfolio manager on their performance, the medium and long-term, I'm talking like 5 years plus performance numbers, those would be a better indicator of their skill. Seeing how the portfolio did last quarter is less about skill and more about luck. You might be asking, what does this have to do with investing? That's a great question. If you're picking someone else to manage your money, you want their track record to be good based on skill, not luck. So it's really important to understand the difference between the two. Also, investors have to make lots of decisions. A great way to learn if your decisions were made well is to figure out how much of the decision outcome was based on skill and how much of the decision outcome was based on luck. Basically, what I'm trying to say here is that separating luck and skill gives you a better ability to make good decisions and a better way of evaluating the performance of other people. Separating luck and skill is important because it can help you understand what are repeatable success strategies and which strategies just worked because of luck. This sort of stuff is really important in investing. I want to mention that most of the content for this episode is from Michael Maubousin's book called The Success Equation. It's all about how to think of luck and skill and how to separate the two. By the way, Michael Mauboussin is the head of research at Counterpoint Global, and previously he was the head of global strategies at Credit Suisse and chief investment strategist at Legg Mason. So this guy is the real deal, and the research that he has done in investing is top notch. So credit for the content in this episode goes to Michael. Alright, so what are some useful ways to think about luck and skill? One helpful mental model to use is to think of a spectrum. Luck is on one side and skill is on the other side. And you can put any activity along this line based on how much luck plays a role and how much skill plays a role in winning at that activity. One good way of testing if something is pure luck is to try and lose at that activity on purpose. If you can't lose on purpose, then it's mostly luck that determines who wins. On the luck side, you have lottery and roulette. You can't lose on purpose in those games, and there's no professional lottery players or professional roulette players. When good old Billy Bob is playing scratch lottery at the gas station, he doesn't have a way to lose on purpose. On the other end of the spectrum, you have something that is mostly skill. Chess is one example of that. It's a game where skill dominates. If you're a beginner chess player, there's no way that you'd beat a grandmaster. And Michael's book says that investing is closer to the luck side of the spectrum, which is an interesting thought. And that kind of makes sense intuitively. You can have a chimpanzee throwing darts at a list of stocks, and there's a chance that the chimp's picks would beat a professional money manager. If you ask a chimp to play chess, there's no way that the chimp is going to be winning that game. Okay, so investing is something that combines both luck and skill. Makes sense. Now let's get into talking about decision making and the results of those decisions. If you made a decision and in the end it turned out to give you a bad result, does that mean that your decision making was wrong? To explore this, let's go back to the football story. You can make the right decision based on probabilities, but it can still lead to a bad outcome. The Seattle coach made a good call, but luck was against him. A good way of thinking about this is that the outcome is outside of your control. There are things that you can control, like the decision-making process, but the end result will still have an element of luck attached to it. Good decision-making does not mean that you'll always get a good result. As an example, there's the story of the long-term capital management hedge fund. We previously covered this in an episode. They had great analysis and a ton of PhDs working on their investment models. I think their decision making was good, but they didn't anticipate some events that had a small probability of happening. Well, turns out that those small probability events happened, and luck wasn't on their side and the hedge fund blew up. Now, the other side of this is if you make a decision and in the end you got a good result, does that mean that your decision making was right? This is where people get into trouble all the time. Maybe your decision making process was flawed, but you got lucky and the decision turned out to be right. Results are essentially separate from a good decision making process because luck can always play a role. So it's important to drill down to your decision-making process and make sure that it is rock solid. If you make a bad decision and get lucky, you want to be honest with yourself and know that's what happened so that you can make better decisions down the road. Okay, so we've covered why it's important to differentiate between skill and luck. Why is this so hard to do? The tendency is for people to make this conclusion. Whatever I achieve is all because of my hard work and skill, and whatever I fail at is because of bad luck. These are the mental blind spots that all people have, and they're hard to overcome. We've discussed some mental blind spots on the show before, and Charlie Munger has talked a lot about the importance of identifying them and doing your best to overcome them. One of these mental blind spots is called the self-serving attribution bias. That's a very fancy name, so I'm just going to refer to it as the patting yourself on the back factor. The average person is really bad at this one. Whenever something good happens, they love to attribute it to their ability or to their hard work. I'm guilty of this one as well. There's lots of times that the good results didn't happen because of hard work, but just because of pure luck. Being honest with yourself is critical to overcome this blind spot. Because if you got a good result from being lucky, it's important to check if the decision you made was actually a good decision in the first place. Next up, I want to dive into what investors need to do to help them get better results. But before I do that, I'll quickly mention that if you're enjoying the podcast, please give us a rating if you're using Apple Podcasts, and please subscribe using your podcast app. And if you know someone who would find this content valuable, please share this episode with them. My goal for the podcast is to help people learn the lessons from the best investors and to help people understand the stock market better. I think that's important today as there's lots of information out there that can lead people on the wrong path, and I would love for more people to benefit from this type of content. Alright, back to the show. So if investors can't increase their luck, how can they get better results? Michael's theory is that you can't increase luck. You have to control the variables that you can control in investing, and that essentially comes down to focusing on the skills. So two things that investors can control are their investment process and avoiding mental blind spots. We've already talked about the mental blind spot component, so let's just discuss the investing process. At a super high level, the investing process comes down to finding out something that the market doesn't recognize and that you recognize and that you are right about. When you do that, you're essentially finding an undervalued asset. Areas of the market that are less known and popular are areas where skill can play a bigger role, because those areas of the market are where the assets are going to be more mispriced. This is what Warren Buffett and Howard Marks have talked about before. You need a fertile hunting ground where there's lots of mispriced opportunities. And the thing that Michael really recommends is having a good investment process. A good process will help you avoid unforced errors in your decisions. Especially when investing, doing well in the short term doesn't really tell you much about your skill because you can have the perfect analysis for your decisions and the markets can still go against you. Or you could throw a Hail Mary investment on a stock and for no reason, it takes off and gives you a huge gain. In those scenarios, which investor do you think is going to have more success over the long term? The one with a good process, of course. Michael says that one of the simplest ways of improving your investment process is by having a checklist that you go through before each investment. Here's a list of a few items that we've talked about on the podcast before that could be part of your checklist. Do I understand the business? Can I explain the business in simple terms? Does the business have a durable moat or competitive advantage? Are there headwinds or tailwinds in the overall market? Is there a chance that the business would be disrupted by cheap labor from overseas? And so on. Once you have a checklist of items to think about, then you can take some time to answer each one, and that will force you to focus on the skill aspect in investing. Monish Pabrai, who's a great investor, uses checklists all the time. I remember an interview where he mentioned that his checklist has over 100 points that he goes through. Now, he didn't mention exactly which items are on his checklists because that's a source of his competitive advantage, but the broad categories he looks at are valuation, leverage, management, competitive advantage, and personal biases that he might have about the company. And once you have a checklist, it's important to review the checklist and refine it over time. This way, you force skill into the investment decision-making process. All right, Vision Nation, so we've covered a lot of ground in this episode. Let's do a quick, rapid-fire recap of the key concepts. 1. Investing has an element of luck and skill, and investing has a lot more luck than most people realize. 2. Good decisions can lead to a good result or a bad result. Just because the result was bad doesn't mean that the decision-making was bad. And just because the result was good doesn't mean that the decision-making was good. Focus on the investment process because that's where you can apply your real skills. You can't control your luck, but you can control the investment process. And 3, having a rock-solid investment checklist is one of the best ways to improve your investment process. If you've enjoyed this week's discussion, I recommend you check out episode 7. In that episode, we discussed Warren Buffett's purchase of See's Candies, and we go into detail on business moats and competitive advantages, which is something that most investors would have as one part of their investment checklist. That wraps it up for this week's episode. If you've enjoyed it, please hit the subscribe button, leave a review, and if you know someone who's interested in investing, please share this episode with them. Thank you, and I hope you have an amazing day. This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Before making any decisions, consult a professional. I may maintain positions in the securities discussed on this podcast. This show is copyrighted by Wall Street Vision. Written permission must be granted before syndication or rebroadcasting.